Jim Brogan joins us on the Triple H Radio Experience. Jim Brogan, thank you for being here today.
Good afternoon, Hallerin.
Let's just start with an overview of where you see the economy right now and where the market is right now.
You know, it's kind of interesting, Hallerin, because the soft data, like if you look at things like consumer sentiment, what do businesses' outlooks look like? If you look at that kind of what I would call soft data, it's very concerning. People are not real optimistic. But if you look at the actual hard data of what's taken place, it doesn't paint the same kind of picture. Companies are still profitable. They're not increasing top-line revenue growth, but they're increasing efficiency, especially with AI, and that's increasing margin. So they are they're hitting good profitability numbers. Unemployment still has not clicked up more. Of course, it is up over 4%, but it's not clicked up more. So, the data really is pretty strong. I mean, we are seeing a little bit of signs of economic slowdown, but nothing significant. So while I certainly can't promise that we're not going to enter a recession, I personally would be a little bit surprised. The number one thing I would look at that could maybe change my impression would be, inflation having a significant uptick. So that's the main thing I'm watching.
The Federal Reserve, the chairman of the Fed, Jerome Powell, was on Capitol Hill, and all eyes have been on the Fed as to what was going to happen with rates, et cetera. Talk about what you've observed about the Fed and rates, and how is that affecting portfolios?
A great question. So the Fed is talking about the back half of the year possibly having 2 rate increases, but it is interesting because there were a few of the members of the board that are not for any rate increases the rest of the year. The bottom line is they're going to react. I mean, the Fed is, they give these projections, but you never know what they're going to do. It's going to be based on the data that presents itself when the time comes. And the market is kind of pricing in 2 to 3 rate cuts. So I do think we'll get probably 1 or 2 rate cuts by the end of the year. But I want people to be cautious with that, Hallerin, just because the Fed cuts their overnight federal funds rate. That doesn't mean that mortgage rates or car loans are necessarily going to go down on the interest rates because, mortgages are 20 and 30 years. Car loans are usually 5 years. So that's different than the overnight borrowing rate. So we really I don't know how confident I would be that mortgage rates are going to drop. Just don't know.
What adjustments are people in retirement having to make given the way the economy is performing right now? Are you having to adjust how you work with certain clients that are right now in that phase of their retirement where they're not creating income and they're drawing down what they've saved? Have you had to change your approach to how you're advising them?
If anything, Hallerin, I would say it even accentuates some of the things that we talk about, and I talk about a lot on the radio program, on my radio show, which is, you don't want to depend on the stock market in the short term because the stock market is completely predictable in the short term. So you don't want to be selling off investments to generate short-term income. Now, I am getting more clients expressing some concerns about inflation. They're actually seeing it affect their budget. Retirees typically live on more of a fixed income. But the bottom line is we haven't seen our clients necessarily need some big, huge increase in income. So, again, it's back to, having some short-term security. But, Hallerin, more and more people are living to 100, and it is very important over the long term. I'm going to make kind of a comment here that might seem kind of shocking, but I would say a 65-year-old retiring today, a bond portfolio is riskier than a stock portfolio.
Really?
Yeah, because it's certainly not riskier in the short term because the stock market's a lot riskier in the short term. But in the long term, a diversified stock portfolio given time has not been that risky historically.
So you're saying because people are living longer, normally when you hit 65, you would try to do the most conservative thing you could do. Have some guaranteed income, low risk. You might go into bonds or something like that where you had a guaranteed income, low risk. You could protect your assets because you thought you were going to die by 75. So you're looking at a 10-year sweep versus somebody at 65. you still got a lot of living if you're going to live to 100. And if that last 10 years is going to be pretty expensive, you might need to think more like a younger investor. Is that what I'm hearing you say?
I am saying that you want to be careful you're not too conservative. That could be a bigger risk than being too aggressive in some cases. Certainly, you want to have some of, when you talk about guaranteed income bonds, some of those things. I mean, people at retirement age and pre-retirement are probably going to need some of that. But the idea of having, 40% of your portfolio in bonds, I think that's very, very dangerous. I know that as of last fall, Hallerin, the real return on bonds over the last 100 years, if you look at the 10-year Treasury, the 100-year, the real return, how much above inflation, they made 0% over 100 years.
Really?
Yep.
That's shocking.
It is. People aren't aware of that. So now, certainly, the stock market's riskier in the short term, which is why I kind of go back to what I said. We don't want to be living on those investments where we have to sell off shares, even if they're down in value. But in the long term, we've got to have some mechanisms to fight inflation if we're going to maybe live for 20 or 25 or 30 years in retirement.
One thing I've never asked you about is crypto.
What would you like to ask me about crypto?
Well, I know that the Trump family is pushing heavily into this. A lot of people are talking about crypto. There may be some loosening of regulation to advance cryptocurrency in the United States of America, but I don't think I've ever had a conversation with you about it.
Yeah, I think crypto it's a highly speculative investment. My recommendation would, if you're going to use any kind of real dollars, would stick with the main two, which is Ethereum and Bitcoin. I know Bitcoin's back almost at all-time highs. That doesn't mean it's not going to be a lot higher in 10 years. There's typically two things, I think, schools of thought of what could happen. Either one, Bitcoin and Ethereum become a really real part of how we conduct commerce on a daily and weekly basis in the future, in which case those investments should pay off in a pretty big way, or that's not going to happen, and it's going to prove to be nothing more than speculation, and it could crash. So as an investor, I think you just have to recognize it for what it is. It's highly speculative, and to not have too much in your portfolio. I think 1% is probably okay, but got to be careful. You get up to 5-10%, I think that's dangerous.
All right, do you have any classes coming up? And let's talk about what's coming up on your show this weekend.
My next class will be in August. I've got a one-night class at Pellissippi State on income planning. People can find out all my fall classes, Hallerin, both one-night and two-night classes. If you go to my website, broganfinancial.com, and click on classes, you can pull up the whole schedule and click to register directly with either University of Tennessee or with Pellissippi State. My radio show this weekend, I'm going to be speaking with Men of Valor. Our guest is Brian Belser. He's a minister by trade. Exactly, and I'm excited about it to see what they do to help men transition back into society and lead productive lives. So that I anticipate that's going to be a great discussion.
Jim Brogan, you're the best, buddy. Thanks for being on the broadcast today.
Thanks so much, Hallerin. Have a great day.